Forward contracts. This is episode 2 of Demystifying FX. In the first video, I explained how forward contracts are agreements to sell one currency to buy another at an agreed rate on or by an agreed future date. The on or buy bit refers to whether you book a fixed or an open or window style contract. Booking a forward contract might require the payment of a deposit known as initial margin, say 5% of the contract value, and your net position will be subject to margin calls. A margin call occurs when your net position devalues by more than your held deposit amount or any credit terms that you might have in place. All of your forward contracts are revalued every day in a process called marking to market. When you enter a contract, that contract has a value, and that value is the P&L that would result from closing the position. Basically, if the market rate is better than your contract rate, your contract is out of the money and would result in a loss, hence it may attract a margin call. Now we know what a forward contract is, what's the point? Currency markets can be volatile. This means import costs or export revenues can fluctuate significantly over time as exchange rates move. This is bad, as you can't run a business with a random variable causing havoc on your bottom line. Forward contracts give certainty over future exchange rates and therefore certainty over profit margins. More than 70% of SMEs incur losses due to currency fluctuations, and more than half of CFOs report lower earnings due to unhedged FX risk. But more than 90% of large corporates have a formal FX policy. That shows us that SMEs tend to be less prepared for currency fluctuations, but the tools and techniques are available. Figuring out whether forward contracts are right for your business starts with considering the visibility and certainty of future cash flows and how sensitive your business is to changes in FX rates. Can you pass rate changes through, or do you have fixed prices, for example? If it's appropriate for you, you can then think about how much, how far, and how often to book forward contracts. For some businesses, hedging near to 100% of future forecasts is sensible, and for others it isn't. But at this stage, it might be useful to take some guidance from an industry professional. And that's it for now. For more information, please check out our website and our blog. There's loads of articles on forward contracts, currency risk management, and everything in between. And next week, we're looking at forward points.